we, go on to the concludatory portions of the episode, Sanjay, I would love to understand from you at the very fundamental level, since you've been at the operator end as well, you founded a couple of companies, and now as a VC as well. What in your experience are some of the fundamentals to be very aware of while deploying capital and while going after this chasing the money chase, run? Because simply stated, like a lot of founders, again, like you mentioned this in the past as well, don't raise more than that is required, right? And be very particular about how you utilize it. So would love to go into, a couple of nitty gritties as to how funds, how founders can actually raise funds and deploy it. I'm sure it varies from, case to case, and it's very subjective from company to company. But if you could, probably generalize as to what are some of the key functions that capital can be deployed for.
Yeah. So first of all, to your conclusion on the previous segment, the venture capital is a business where you write the exams and then you wait 12 years, 10 to 12 years for your results.
Right.
We're still in chapter one. I wouldn't
That is true.
dare suggest that we're successful or anything like that. But certainly we've been privileged to work with some amazing founders who are working very hard to try to make us successful with our returns. Sorry. So to come back to your question, I always feel, capital is a tool. It's not a weapon, right? And there may be certain businesses where it can be used as a weapon, but for most good startups that we at least like to back, it's a tool, right? And in some ways, it's a tool perhaps that could help accelerate it a little bit and solidify it. But the business was fundamental in its own rights, right? And would have always been good. It's the question of, can our involvement with the combination of capital and time make it great, right? And can you move it from a good trajectory to an exponential growth trajectory, right? Can you move it from a good, from a good foundation to sort of, thinking really large and perhaps go global and things like that, right? So capital to me is a tool, and that's the only thing it should be. In fact, I think it's probably the most expensive tool for entrepreneurs because you give up something very precious. It's called equity, right? So first of all, is your business even the right type of business for venture capital, right? There are many times I get into phone calls or Zoom calls now with founders, and my conclusion at the end of it is, you really have something good going. Do not mess it up or screw it up by taking venture capital. That would be the wrong thing for you to do, right? I literally 3 days ago had a similar call with the founder, right? Because to me, the business, at least the way I saw it, and of course, I would have to say that everything I say to founders is a point of view. It's not, it's probably, it's just that. It's just a point of view, right? But my point of view. So I think the first question I ask people is the prize worth winning, right? Because it's actually, in my view, it is harder to build a small company and easier to build a large company, right? Because as strange as it sounds, right, this is one of those where scoring a century is easier than scoring 30 runs, right? It's just almost impossible to score 30 runs if you're aiming for it, right? You may aim for the century and end up with 30, but if you're aiming for 30, you're never going to get there, right? So is the prize worth winning, right? Is very important here, because what ends up happening is, see, capital follows ambitious opportunities, right? And so if you're aiming to do something very, very big, right, actually the world conspires to help you get there. It's very strange, it's hard to explain, but that's the reality of what happened. And there are countless examples of this, right? So having said that, having lofty aspirations cannot come at the price of having, a well-grounded execution plan, right? And the combination is what is important here. But having a well-grounded execution plan without lofty ambitions means that it might still be a very attractive business for the founders and for the team members, but it just is not a venture capital fundable business, right? So the first thing people need to establish is, am I potentially on that trajectory or not, right? Second thing, of course, is risk, right? And we're all comfortable taking risk, right? The reason you take risk is because the small probability that this could actually succeed is really worth it, right? And that's where, you're going in saying, can this really scale to be a $100 million revenue company? Even if there's a small probability, I might be willing to take the risk. And as founders, that's what we're playing for, right? Whether you achieve it or not is a separate issue, right? So broadly, I look at it as there are three trajectories that startups follow, right? At least, and all three are positive, right? The first one is what we all aspire for, right? You know, you get in, the market catches fire, you timed it perfectly, you hit escape velocity, great things start happening, people start chasing you with capital, you're getting revenue, or continuously creating value from day one, right? That's the dream, right? It happens maybe 5% of the time if you're lucky, not even that, right?
Right.
But it can happen, right? And when you have that opportunity, or if you have a sign that you're hitting that, right? I mean, there may be some iterations that you go through, but suddenly you start hitting escape velocity, right? And when that happens, I think you owe it to yourself, right, to try to build the biggest company possible, right? You don't get these opportunities very often, right? So for those, I tell founders, absolutely go raise and raise ahead of when you created the value, because people are seeing the outcome possible. Build the strongest team there, absolutely right. The other extreme, which I think is really the next best outcome, is where it's a complete disaster from the beginning and you shut down, right? Because for founders, opportunity cost, and even for investors, right? Actually, our opportunity cost is the most expensive thing, which is our time, right? It's less about the money, actually, right? I would rather have a company shut down than get into the living dead situation, right? The third one is one where, it's going okay, it's not going great. There is still hope that it might go great, but it is not clear, right? And founders here are caught in this forever, right? Because it's too hard to give up, but it's not happened yet, right? And those actually are the trickiest ones. And it's the hardest conversations to have with founders. Like we're going through that. We went through that with one of our companies. And the founders had the maturity to say, you're right, this is not going to be a big company, we might do very well. And so they found alternates, and thankfully things seem to be working out in that case. But it's very hard for founders today because they put in their blood, sweat, and tears and toil and everything into it. And it's a very emotional decision, and it's kind of seen as failure, which which is, who cares, is the reality. But what's most important is, and I remember one of my friends actually was doing a startup. I had him come and meet one of my partners, and he told his story. Obviously, we were not looking to invest or anything, but he had put a lot of personal money in, right? And he and his co-founder had sunk about 4 to 5 crores of personal money. This is, I'm talking 2012, 2013. And he met my partner at the end of 20 minutes. My partner said, "You should shut down the company today," right? And my friend was in shock. I said, "How can you even suggest something like this," right? Because they had put money in the company and it was making some revenue, right? But 2.5 years later, they shut down the company, right? And now probably for everyone that we have said shut down company, they have probably also rebounded, right? So it's hard to say who's right, but broadly speaking, from a venture capital entrepreneurship ecosystem perspective, if you hit escape velocity or you shut down fast, it's getting into the yellow zone, I call it, right? Where you're neither here nor there. It's not going away, but it's just not catching fire. That's a very expensive thing for everybody, because it's a big time sink for us. It's a big bit. There's of course investment dollars that's gone into it, but most importantly, the founders are losing time, right? And they're never going to get this time back, right? And losing time in hope, and obviously we don't want to give up too early, right? So this is where the thing is, right? Well, it's just around the corner. It's just around the corner, and it appears that way several times. And dealing with that is the hardest thing for founders. But broadly, in the first category where you're in green zone, raise the capital, go for it. I think it's great. In the second category, you don't have that option. Things just fall apart. It's not a bad outcome. It's just not what you were aiming for. In the third situation, I always say, do not overcapitalize the company in the yellow zone. Because if you overcapitalize that company, you can never sell that company, right? So to come back to your original question, I say, till you're confident that you're in the green zone, don't overcapitalize the company. Right? And that's the lesson I give founders. And the realities will vary from company to company. And that's not to say that green zone companies will eventually get there, right? But there is a genuine belief that they could get there,
Right.
right? And that's all that matters, right? It's a probability game again that we're playing, but the prize is worth winning.
Right. Right. Got it. Wow, this is again very like I love the detailing in terms of being able to accurately, go through the stages in which a company may progress and what are the realizations from it. Furthermore, I cannot help but ask, like I'm sure everybody who's listening would like to know, but what is it like as a, through the lens of Prime or either as an independent, experienced professional in the ecosystem as well? What is it that you're looking for in a founder? Like if you had to like crisply answer this, so that these are cues. I'm sure like nobody trains themselves as a founder. It's a journey which is worth evolving. But if you're looking for a couple of specifics, could be traits, could be particulars, would love to understand that and know better how that pans out
Yep.
for you and what's
Yeah.
the thought process like.
Yeah. So I'll tell you what I think about. It's not necessarily exclusively what we look for at Prime, and my partners might look for something different as well. So
Right.
we don't all have like a very common point of view, and a lot of this ultimately is gut feel, right?
True.
As much as we would like to make it scientific in the decision, right? But the first thing I look for is so I'm a firm believer that people will buy from startups because it's an aspirin, not because it's a vitamin, right? So whatever. So that means that you really have to have a very deep and unique understanding of the problem and the customer that you're serving,
Right.
right? So I actually couldn't care less what the solution is, what you built so far, because I know that can be changed, right? But do you have a passion to serve this customer and really understand what the problem set is for that customer, right? Have you understood that in a manner which is uh, really a competitive advantage to you? Because if somebody sees what you're doing, right? So one thing at Prime is we only invest in what we call category creating companies. We will never invest, I shouldn't say never, but we almost never invest in a clone of something that's already out there, right?
Got it.
Which means that you, as the first mover, um, have got a lot of time, theoretically speaking, to evaluate, and to really understand the problem of the customer, right? Once you've come out with your solution and somebody else says, "Oh, that's an interesting one. I should do the same thing," that person is just chasing your tail, and they don't have the benefit of all the research that you did, all the reasons why you decided this color should be pink and not purple, all of that stuff, right? They will just copy purple because that's all they saw, right? And we have seen that in a few of our competitors of our portfolio companies. The thought process is missing, right?
Right.
And the understanding of the problem is missing, right? Because they're only looking at you, right? So how thoroughly have you researched the problem? How closely have you understood the customer's needs? Why is the customer buying your product, and what problem you're solving for them, and why is it so important and unique and strategic? That's something that I obsess over, right? I really really want to understand and appreciate that. The second thing is, why will you succeed when others can't?
Right.
Right. That's also very important because we're not just backing any company, we're backing this company, this founder, right? So, what does this founder know about distribution? What does this founder know about business validation, business model validation? What will the second and the third product be because they understand this market better than anybody else, right? So that's a second important thing. Obviously, there are the unique things like I mean the standard things like what's the size of the opportunity
Right.
and so on, because all that needs to add up. So these are sort of some of the unique things. The third thing I look for, and I tweet about it, I talk about it, and I could say for every 20 founders, maybe one of them practices it. Right? I always start the meeting saying, you know, great to meet, would love to know what you're doing, and happy to start by telling you about Prime and what we look for and how we invest, right? And then I say, let me know what you think. Let me know how you'd like to proceed. 1 in 20 founders will say, tell me more about Prime, right? And what you look for, right? And it's not that I want to gloat about us. To me, that's a very simple test of if you are in front of a customer, are you going to blabber about your product, or are you going to ask the customer 20 questions before you talk about your product, right? It's a sales process. Here you're looking to sell your company. have you even understood whether this customer is the right one for you, right? And you'll be shocked how few founders actually ask 5 questions. The other day, I was in a meeting where a founder actually asked, I was WhatsApping privately to my colleague, and it's the first time it's happened in a long time. But the guy actually asked me 3 questions and said, "Why should I even be talking to you?" Right? I love those situations because that's what he's going to be doing in front of a customer, right? When somebody comes and he's interviewing someone, he's going to ask about that person, right? He's not going to be just sort of he or she is not going to be just blabbing about what they have, and the customer saying, "I don't need any of these features," and then there is actually four other features that you did not talk about that the customer actually wants, right? So you have to learn to understand. So if you ask me what we look for, deep understanding of a problem set, right? With of course large market and all that, strong passion, and empathy for that customer, right? And desire to solve the problem. Some initial proof that what you've done is thing. We also look for a very strong product thinking, right?
Right.
Because our view is tech and the nimbleness with which you solve product problems is going to be a thing. So that would come in the founding team. And lastly, just the ability to listen and have a conversation with, right? I think we need to be able to work very closely, right? Some of these are hard to quantify and they're intangibles, right? But that's what I look for. And of course, if you have figured out distribution, right? Because we also think startups have a limited shelf life, right? You have to crack distribution before the competitor or the incumbent does, right? Does crack the innovation side of things. So you need to be able to get big fast and stay on the radar and get to critical mass before others come into the space. Right? So those are some of the things we look for.
Got it. Got it. I especially love, the factor about the pain point and, the fact that there needs to be customer empathy and the listening factor. I love that test of yours as well, and how you mentioned that, only 5% of the founders do that. Goes to show that, you have to be able to practice the basics well as well. And it's not just a complexity game, as you mentioned earlier in the episode. Wonderful to hear that,
Yeah.
Sanjay. And before we close out, I'd love to know just quickly a couple of more things about you. We've spoken about your career, we've spoken about Prime, we've spoken about founders, but I'd love to understand more about, the fintech expertise that you've had, because as you mentioned earlier, you were ahead of your time, and there were things that you were developing that maybe the market wasn't mature enough to understand. So at this instant, what's your opinion on fintech? I know this is broad based, but a crisp answer would really benefit the audience. And lastly, like if you could also correlate that with your experience in the Aadhar committee. Firstly, like how do you get an opportunity like that? I'm very curious to understand. And how do you leverage that in terms of a general life experience? Because what happened, I'm sure what must have panned out through that committee has given you experiences, has given you people to work with, and a memory of sorts that helps you throughout your career. So if you could probably touch upon
Sure.
these things.
I'll talk about Aadhar. It wasn't a committee or anything. We were in the core team that was working alongside the government, about 15 volunteers. Some, really, you know, luminaries like Raj Mashwala and Pramod Verma and Sanjay Jain, Vivek Raghavan. He worked several years. Mine was a smaller stint, about 12 to 18 months. And also more around evangelizing, looking at applications of Aadhar is where we were working on, but during the very early days, first 12 to 18 months. And that evangelization on a personal basis I've been doing forever, right? It's in the bloodstream now. I think that a lot of takeaways there. One is, of course, it was a privilege of an opportunity which happened more by accident. It was one of timing also that I just left MCheck and I was thinking of what to do next. But I'd had a lot of first-hand experience of what we could not scale at MCheck as an entrepreneur because of the lack of something like Aadhar. I shouldn't say because of, that was one of the contributing factors. And so, when the opportunity was there, I said, well, this is definitely something that can be transformative. Let me see if I can help through my experience in any which way. That was the only motivation. And, I would like to believe that we, gave it the best of all our experiences, all of us who participated in it as volunteers. And I think, we're really lucky and proud to see, what we have achieved, right? If you think about the scale of Aadhar, India enrolled the country of Singapore every week for 7 years in a row, right? That's literally what we have done, right? And if you think about it at that scale, it's mind blowing, right? Or Australia every month for 7 years in a row, right? It's astounding what we have done in India. I think it, in terms of benefits, apart from the ability to continue to keep talking about it over the years, because it was such a unique experience that that in hindsight was something that I never thought would pan out at this scale. So it's really exciting even to reminisce about some of those things. I still recall the first day, the first Aadhar was rolled out, and all the way through to now. Um, I think thinking at government scale was very, and a lot of respect for the government, right? As private sector guys, we try to be very cynical about, oh yeah, government, it's a bunch of babus that don't do any real work. That wasn't true at all. They were such incredibly smart people I got to meet, right? And their ability to grasp technology, to be able to push back and say, but do you know that in a country of 1.3 billion people, 0.05% is actually 6.5 million people? It's like the country of Singapore, right? And if my arithmetic is right, and we can't have that, right? Those people don't have proper fingerprints, right? You can't just assume it's only fingerprints, right? So thinking scale, I can really empathize now when we look at the pace at which a government rolls something out. Oh my god, all the corner cases, because they cannot not serve any one citizen, right? They just cannot say, well, it's only small 0.05. Private sector, we can say, forget it, we won't serve that customer, right? Private sector looking for which 0.05% we want to serve. The government has to serve 100% and cannot use that 0.05 as an exception and say, well, it's only 0.05, right? So those, I think some respect for the government system was something that was a incredible surprise to me, right? And now I can empathize, and I'm happy to roll up my sleeves and help in any which way, but I understand their constraints, right? So I think that's important as well. Now, sorry, I missed the earlier part of your question.
Your idea on your take on fintech in India.
Yeah, on fintech. Sorry, fintech, right? Yeah. So I think my bigger thesis in India is all things will get digitized, right? So whether you look at a MyGate, which is digitizing the front gate, or a Wheelseye, which is digitizing trucking, or a M-Fine, which is digitizing healthcare, or several of the fintech plays that we have in our portfolio, the broader thesis we have is that whatever is in a paper-driven offline process will get digitized, right? And it's happening at breakneck pace, right? So because everybody wants to, whether you're a small kirana shop or whether you're a larger corporation, you have to digitize to survive, and you have to digitize to thrive, right? So that's the bigger thing. Now, one of the first benefits that comes out of digitization is the fact that there is a trail of data which can be processed through AI and through software, right? And the biggest reason why all of us struggle to either invest in our businesses or invest in our personal lives is because of access to credit. And credit worthiness can only come when people have information about you that they can analyze and they can determine, are you credit worthy or not, right? So historically, needed to be, I needed to verify a certain number of assets of yours and so on. And it was very expensive to verify all of that. And therefore, unless it was a certain ticket size loan, or a ticket size loan, it made no sense for me to even spend the money and the time to try to analyze, are you credit worthy or not, right? Now with digitization and through technology, it doesn't cost me anything to analyze your credit worthiness, right, or the customer's credit worthiness. As a result, we can democratize the access to credit, right? So financial services, if you think about credit as one, the same thing is true with investment, right? It used to cost 1,500 rupees to verify somebody before you gave them the right to buy mutual funds, right? The KYC process, right? So if you think about an AMC, the commission structure there is 0.5%, right? So at least they have to recover the commission in the first year, which means that minimum you have to invest 3 lakh rupees. To invest 3 lakh rupees or whatever, $5,000 equivalent, 4,000 these days, it meant that you needed to be earning at least 10 times that, right? Because only 10, that's broadly what people put, right? How many households in India earn 30 lakh rupees, right? It's a very small number. That is why, all these campaigns now of mutual funds say make sense, because in the past, it just didn't make sense. Very few people could invest, right?
Right.
But now that we've driven the cost of KYC virtually to zero, because you can do an Aadhar eKYC with an OTP on your mobile phone,
Yeah.
right? That 1500 has become close to zero, right?
Right.
Now you can invest 10,000 rupees a year. So think about how many people could have invested 30 lakhs versus could have invested 3 lakhs versus people who can invest 10,000 rupees, right? It's
Right.
at least 100x bigger opportunity. Right?
True. True.
Now, that is the beauty of fintech and the opportunity, right? Is that the cost structure is changing to the point where we can democratize it. And now what will also happen is you will move away from one size fits all,
True.
right? So earlier, HDFC Bank had one mobile app and it serves everybody. It doesn't matter whether your net worth is 1 lakh or 1 crore or 1,000 rupees. It's exactly the same thing, right? And it doesn't really, that's not how we think about managing our money. But the moment you can have this sort of accordion like scalability and personalization that could happen, suddenly now there'll be multiple solutions, right? And the beauty that we have done, or what we've done with UPI, right? We don't
Right.
have to think of money the same way. We don't have to interact with our money the same way. But I want to do it in my way. You want to do it in your way, and the opportunity is now being provided. So the fintech opportunity in India, I think, and if you ask everybody, I look at it as there are three categories of users: those who are unserved, those who are underserved, and those who are poorly served, right? Actually nobody is happy, right? Even though people like us who have, you and I have access to all the financial services providers we want, we're not happy with how it's done, right? Because we have our own opinion of it, right? And they're doing
Right.
the best they can. But why can't I have something else, right? So the beauty of how UPI is architected is that I can choose my favorite app, and it might be completely different what somebody else in my bank is doing, right? And that's how technology has been architected. And so that creates opportunities, right? If you think about India as a country of 1.3 billion people, everybody talks about that number. To do a startup, right, you need to plan something that's going to get to say $100 million of revenue in 3 to 5 years. That's gold standard, right? You can serve a niche of a million users, right? Making 100 rupees a month, right? $1 a month ish, right? So you do the math, right? You need 10 million users, 8 million users, and you're $100 million revenue company, right?
Right.
8 million users out of 1.3, you're not going to look at 8 divided by 1.3. You're going to find a segment which might be 35 million users and say, can I get 20% penetration in the segment, right? Or 50 million users and get 5-10%, right? Now you can build a very, but that segment is what is homogeneous. And the beauty of the internet is you can distribute to all of them, although they might be all over the country. It doesn't really matter whether they're in Assam, in Jammu and Kashmir, or in Gujarat, or in Kerala, right? They're all equally accessible to you, right? But you
Right.
need to be able to segment them and go after that segment, right? So the exciting opportunity here in India, and whether it's true for fintech and everything else, is that you can now create uh, a target group which is very narrow, very homogeneous, but do an amazing experience for them, so that you can find all of them and you can dominate that sector, right? And that creates a high value enough company, right? If you can create a product which customers will pay 100 rupees a month for, customers could be from either side, right? The service provider or the thing, and you get a million users, you're a $10 million revenue company. You get 8-10 million users, you're a $100 million revenue company. That is a very different situation that we are in now, and that's why fintech is great. So that's why in our portfolio we have Neo for neo banking, EasyTap for payment acceptance, HapPay for B2B expenses, CredX for invoice discounting, MoneyTap we have for consumer lending, and many more. Auto Capital doing two-wheeler leasing. We have other companies doing transaction recon with Reco and things like that. We really believe there is infinite opportunity here in this segment, and we will continue to be very actively investing in this segment.
Great. That is
So
again
it's a
one.
great opportunity.
For sure, and like seems that way, and like goes to show the opportunity that exists is massive in nature, and the stellar portfolio that exists. That was wonderful to hear again, Sanjay. And as we close this episode out, I want to mention, and I'll try summarizing a stellar career into a one sentence, but from an Indian education to then going to Silicon Valley, having a long career, then coming back to India, starting up multiple companies, getting acquired by Twitter, being on the Aadhar Voluntary Committee, if I may call it that, and then starting off Prime, right? The career's been massive. You're an ardent cricket fan. There are other things that you do, very, very active on Twitter, and so many things going on through this amazing career that you've had. I know it's going to be a tough one, but if you had to, summarize the learnings from your career, and I know I'm stereotyping, but it would be lovely for us youngsters to just get a viewpoint from your lens as to how life has panned out for you. What have you learned through, maybe the downturns, maybe the upsides, and what are some of the things that you hold dearly to your heart that you'd like to, probably share with our listeners and give us a cue before we end this episode?
Wow. Yeah. Obviously, we talk about a lot of successes, but a lot of things go wrong along the way. More wrongs than right. I always say that entrepreneurship is 360 days of frustration and 5 days of glory, and in a leap year, it's 361 days. So you don't even get a break in the leap year, right? But those 5 days are what you live for, right? And everything else, is completely, both emotionally and in all other ways, uh, less important. I think broadly, what I've always looked at is this the right thing to do? And that's the only thing that matters, right? And in life, whenever you chase outcomes, it never works out, right? But if you do things for the right reason and do focus on what you're doing, that's the only thing you can control. Actually, often great things happen, and perhaps greater than the outcome you might have chased, right? So my only focus on people is entrepreneurship is not a get rich fast scheme. Venture capital is a get rich slow scheme, perhaps, if at all I can say that. But with entrepreneurs, I think just focus on doing the right thing, right? Financial success is an outcome; it's not a goal, right? And I think I'll leave with that. A lot of other learnings as well, but this is the one thing keep in mind. Why am I doing this? And if the reason is financial success, please don't do it. There are better ways to and easier ways to make money, perhaps. Entrepreneurship is really because you're passionate about something, you want to solve something, and if the financial success comes out of it, that's even better. But never make that goal. If you make it a goal, it will slip away from
Right, right. Wonderful. That has been great to hear. I mean, throughout the episode, this has been such a mature and, healthy conversation where we've understood so many of the fundamentals. I cannot express the gratitude I have for you and the honor I've received by having the pleasure of interviewing you. Thank you so much, Sanjay, for spending your morning with us on the show. It's been a pleasure to host you.
Thank you, Jivraj. All the best. I can see you're doing this with your passion for just doing the right thing and something you're enjoying. So, wish you all the best and look forward to interacting more over time. Cheers.